Welcome back to another video lecture of UN Autonomous College of Science and Technology. I am Amitabala, Head of the Department, Master of Commerce, Finance and Control, and we are discussing the paper Financial Market and Instruments, and in that we are discussing on the commercial banks. Today we are going to discuss that what are the functions of the commercial bank and how it operates. So let's start. So the function of commercial banks are classified into two main or broad categories, that are the primary functions and the secondary functions. So what are the primary functions? Let's see that the primary function of a commercial bank are of three types, and that are the accepting deposit, granting loans and advances, and creation of credit. So as other financial institutions, anything you talk of, there are some functions, and the primary function or the basic functions are the functions that that particular institution is doing in general, or we can say that these are the basic functions. So as in the commercial banks, the primary functions are been broadly of three types, that are they are accepting deposits, they are lending or granting loans and advances, and they are creating the credit. So these are the three basic functions of the commercial banks. Now we will understand that what are these three basic functions or the primary functions of the commercial bank in detail. So let's start with accepting deposits. It is the prime function of the commercial bank, and deposits are the lifeline of the banks, and it collects the surplus balances of the individuals, firms, and finances the temporary needs of commercial transactions. And the first task is therefore the collection of the savings of the public, and the bank does this by accepting deposits from its customers. So the first and the prime function of the commercial bank is accepting deposits. So when we have started the financial system, we have known, or we are repeatedly been saying throughout this paper, that there are savers and borrowers, and these banks are the intermediaries between the savers and the borrowers, and we are saying that they are intermediating between the one who have the surplus money and those who need money for some better avenues or for some investment avenues. So now this is the function, this is the prime function of the commercial bank, by which it is accepting the surplus money, or it is accepting the saving amount that is there with the general public. So the general publics, those who have the surplus money and they want to make it secure or keep it secure, they are not that risk taking, or they are not putting their money for investment, but they want to keep it safe and secure. They are putting the money in the banks, and the bank is accepting those deposits. Now, in how many forms, or what are the ways in which the bank is accepting deposits, or the bank is allowing the money to be deposited with it? So this function of accepting deposit could be of various types, or we can say that the bank is accepting deposits in various ways. So what are these? We will look into the types of deposits. We will see that it could be a demand deposit, which is savings account deposits, or a current account deposits, or it can be a time deposit, and this is fixed deposits and recurring deposits. So the deposits that the commercial bank is taking is of two broad categories, that is demand deposit and time deposits. And in demand deposit we again have two types, that is savings bank deposit and current deposit. And in time deposit we have fixed deposit and the recurring deposits. So what is these types of deposits, or what are these variations, or what are the particular features of these deposits? Let's discuss. So first we will see the demand deposits. So these demand deposits are repayable on demand on any day. So this deposit that can be repayable on the demand of the depositor are the demand deposits. So the deposits that are repayable on demand of the depositors are the demand deposits, and these demand deposits could be of two categories that we have said, that are the savings account deposit and the current account deposits. Now we will see that what is this savings account deposit and this current account deposits. Let us start with the savings account deposits. So these are deposits whose main objective is to save, and the savings account is most suitable for individual households. So if you will look into, or if you will just observe, that almost all of you, or in general, we have the bank deposits or bank accounts that are savings accounts. Or if you will just remind and look into that, when you are operating your ATMs or when you have to fill in about your bank details, there are the types of accounts, and you are clicking in or you are ticking the savings account. That is actually this type of accounts, that is the savings deposits, and this is in general for every households, and almost all the households are having this type of account. In that you are allowed to deposit money with the commercial banks, and they are payable on demand and also withdrawable by check, and interest is paid on the basis of the amount and number of days the amount remains credited in the account. And the bank provides facilities like checkbook, ATM card, etc. on these savings account deposits, and there is limit on number of ATM card withdrawals from other banks' ATMs only. And a minimum balance should be maintained in this deposit account, otherwise penal interest is charged. So beyond a number of 20 or 60 leaves, checkbook is available for a fee that is to be paid for this checkbook. So these are the features of saving account deposits. In general, we have this. You must have gone through, or you must be dealing with this type of deposits. This is the type of deposit which is available for the general households, and we are opening an account with the commercial banks or with the bank, and we are having these facilities that we can put the savings, or we are putting our money in these accounts, and there are certain limitations on the time of withdrawals. We can withdraw the money whenever we wish to or whenever we need. So that is why it is under the demand deposit. And there is also a facility of nomination, and which can be registered for this saving account deposits. Next we will see that current account deposits. So these can be withdrawn by the depositors any number of times depending upon the balance in the account, and the bank does not pay any interest on these deposits but provides check facilities. And these accounts are generally maintained by businessmen and industrialists who receive and make business payments of large amounts. And overdraft, that is the short term unsecured loan facility, is available to current account customers. So another type of deposits that is under the demand deposit is the current account deposits. So this is a specific account facility, or it is a specific deposit facility that is there for the businessmen or the industrialists. So what is the difference between the savings account deposits and the current account deposits? If you will see in a broader sense, that the limitation of the withdrawal number, or the number of times the account holder can withdraw or operate the account, is not limited in current account. But in savings account, there is a interest rate that the bank is paying to the account holder on the amount that are being deposited in the saving account, which is not given in the current account. Apart from that, the current account holders get the facility of overdraft, or OD, which we say in short terms, that is not available for the savings accounts. And what is this OD facility? In detail we will be discussing. Apart from the demand deposits, the other type of deposits that the commercial banks takes is the time deposit. So these are fixed deposit and recurring deposits. So what are these fixed deposits and recurring deposits? We will look into. First is the fixed deposit or FD, which we say in short, and these fixed deposits have a fixed period of maturity and are referred to as term deposits. So these are deposits for a fixed term, that is period of time ranging from a few days to a few years. And these are neither payable on demand nor they enjoy check facilities. So fixed means what we understand, that fixed means for a particular period of time. So when the commercial bank is accepting the deposit for a fixed period of time, whether it might be for few days or it might be for few years. So when the period is fixed for the deposition, or we can say that in between the maturity period we are not going to demand for withdrawal of that particular amount, that is called fixed deposit or FD. The bank is accepting the deposits in that form also, which we are saying that fixed deposits. So what is this fixed deposit? Is actually differs from the demand deposit is that the period is fixed and on our demand the bank is not going to give us the money, or if it is going to give the money or release the money, then it is going to charge some penalty on that. They can be withdrawn only after the maturity of the specified fixed period, and they carry higher rate of interest than that of the savings deposit, and certain amount is deposited for a fixed period for a fixed rate of interest, that is the FDR, that is fixed deposit receipt, is given to the depositor. So after the fixed deposits, or when a customer is going to have a fixed deposit or going to give a fixed deposit, the bank is going to give the FDR, that is the fixed deposit receipt. So a document or a written document is going to be given to the account holder or to the customer in which the detail of the deposit is there. In savings account, if you will see that in that also bank is giving us a book, which we say that the passbook, in which the number of transactions that we did is documented. The number of times we withdraw the money, the number of times we deposit the money, the time of deposit we are doing or the time of withdrawal we are doing, the number of transactions are all been inscripted in that book, that is the passbook, which we are saying famously. But in fixed deposit, as there is specification in the withdrawal, or we are depositing the money for one time or for the fixed period of time, the bank is giving us the FDR, that is fixed deposit receipt, which is the document of our deposit with the bank. So a customer can obtain loan by depositing that FDR, and on the date of maturity the principal along with interest of the fixed period is paid. And this premature withdrawal of cash is also allowed for payment of penal charges, and it carries no interest. So the fixed deposit receipt that we are receiving when we are in some emergency, or if we want to get some loan out of that deposit, we can hand over that fixed deposit, or we can keep that fixed deposit with the bank and take or can get loan from the bank on that fixed deposits. Also there is availability of partial withdrawal of money from that fixed deposit. Next is recurring deposits, or which is famously known as RD, in which certain sum is deposited into the account every month for 1 year or 5 years or the agreed period. So it is ideal for persons having regular income to save and receive a lump sum. And interest rate is more than savings deposits and almost equal to fixed deposits. So at the end of the period, the deposited amounts along with interest and returned to the customer. So any institution can open RD account, minors or students can also open this account, and premature closing is allowed but with a charge or deduction. Loan against these deposits also provided by some banks, So this is what the recurring deposits or RD is. So RD is what? When we are having, or we can say that if we are having a fixed surplus of money for say, or we are left out with a fixed amount of saving with us. So we are putting regularly that particular amount of money into an account with the regular interval of time. So when we are depositing the money with the bank with the regular interval of time, then that is called as the recurring deposits, and these recurring deposits are also not supposed to be withdrawn before the maturity time. So as we are not, or the customer is not supposed to withdraw that money before the maturity, it is also carrying a higher rate of interest than the saving deposits, and it is almost equal to the fixed deposits. And this recurring deposits at the time of its maturity is incurring the entire amount that we have deposited till date with the interest amount. This is what the recurring deposit is. Here also the premature withdrawal of money is allowed, or we can say that we can break the recurring, or we can withdraw the money before its maturity, but as we have committed that money for a fixed period of time, for that the bank is also charging some penalties, deducting some amount at the time of its closing. Another important primary function of commercial bank is granting loans and advances. So the second major function of a commercial bank is to give loans and advances and thereby earn the interest. And this is the main source of income of the bank. And advances are credit facility provided for short period, that is within a year, to business community. And loans could be a demand loan or term loan. It is repaid whenever demanded and after the agreed period respectively. So granting loan or advances is the another important primary function of commercial bank. So if you will remember that when we are talking of commercial bank, we have discussed that a commercial bank is accepting money from the savers and it is lending money to the one who are in the requirement or of the need of using these idle monies. And the difference in the payment of interest and receiving of the interest on the lend money is the earning of the commercial banks, and this is what the granting of loans and advances is. So what is advance and what is loans? That advances means what? The bank is lending money or the bank is giving credit for a short period of time, that is within a year. When we are talking of loan, that loan is the amount that the bank is sanctioning either for a demanded period or for an agreed upon period. So that is what the loans and advances is, and on the interest that it is generating from the loans and interest is the earning of the bank. Now what is this advances? We will see that advances could be of three types, that is the overdraft, the cash credit, or the discounting of bills. So this could be the advances that the commercial bank is giving. So what is this overdraft? This overdraft is a credit facility extended mostly to current account holders, and it is an arrangement reached between the banker and the credit-worthy customers. Such customers are allowed to overdraft when there is no balance of money in the account up to a certain amount, usually for 3 months period, and it may be extended for further periods. And only on the withdrawn amount of credit interest is charged and not on the maximum limit allowed. It is an unsecured credit. And secure overdraft against the security of financial instruments is also provided by some banks, and it is repayable on demand. What is this overdraft or OD is? So the type of demand deposits that we have already discussed, that we have the current deposits, which is the facility for the mainly for the industrialists or the, we are saying, the businessmen. So when these businessmen or the industrialists are opening current account with the commercial banks, these credit worthy customers are given with the facility of this OD. So this OD is what? Why we are considering it under the advances? That is the amount the businessman or the industrialist, or we can say the current account holder, can withdraw from the account even if it is the amount is not available in their account. If we will discuss in detail, then what is this overdraft facility is that the bank is giving a OD limit to the current account holder. So for example, we can say the OD limit is 5 lakhs. So up to 5 lakh rupees the account holder, the current account holder, can withdraw from the account, and if the amount is not available in the account also, he can withdraw the money. If you will just observe that when you are suppose going to withdraw money from your account, you are a saving account holder. So when you are going to withdraw the amount from your account, if your account is not having that balance or your account is not having that amount, then the bank refuses to pay you that money. But if you are a current account holder, then the bank is giving you a facility of withdrawing money of your requirement from your account even if your account is not having that amount of money. And this is given to the current account holders on their credibility or the credit worthiness. This is what overdraft is. Next is cash credit. So it is secured credit facility given mostly to business institutions, and stock in hand, raw materials, other tangible assets, etc. are provided as collaterals. A certain sum is allowed as credit for a short period of time, and interest is payable on the actual amount withdrawn and not on the entire credit facility, and it is repayable on demand. So cash credit is what? When we have some collateral, raw material or stock in hand or other tangible assets, and interest is to be paid on the actual amount withdrawn on that, not on the entire credit facility, and that is given by the bank. Next we are having the discounting of bills, and business customers approach banks to discount the commercial bills of exchange and provide money. So it is a short term credit instrument, and banks deduct the discount or interest for the period mentioned in the bill and release the balance amount to the traders. So if the bill is dishonored, the bank can recover the amount from the customer, and it is a form of unsecured credit. So discounting of bill is what? When the businessmen are regularly dealing with the raw material supplier, the traders, so there is always a dealing of money with the businessmen, and they are given with bills of payment. So the bank can discount the bills of payment. That means what? Before the date of payment, the bank can pay the money to the holder of the bill with some interest, with the deduction of some interest, and if that bills of discount is been dishonored after date of its realization, then it is going to recover the amount from the account holder. So this is what the discounting of bills is. As it is done prior, it is also considered under the advances. Next we will discuss of the loans. So it is a definite sum of money lent for a definite period, and it is repayable in one lump sum or in installments, and interest is payable on the entire loan amount. Every bank in these days design new methods of advancing loans to find more ways of earning their income, and these loans could be demand loans. That is, these are such loans that can be recalled on demand by the banks, and the entire loan amount is paid in lump sum by crediting it to the loan account of the borrower, and thus entire loan becomes chargeable to interest with immediate effect. And it could be a term loan. These loans may be given as personal loans, loans to finance working capital, or as priority sector advances. So these are made against some security, and entire loan amount is transferred to the loan account of the borrower. This is what granting of loan is, or we can say loan is. The loan can be a demand loan or it can be a term loan. Loan is what that immediately when it is sanctioned to you, the interest rate is effective from the very day. The interest is going to be calculated. So it could be a term loan or a demand loan. So apart from these two primary functions of accepting deposits and lending advances and loans, there is another important primary function of commercial bank, that is the credit creation. So what is this credit creation? Commercial banks increase the supply of money by creating credit, which is also treated as money creation. And money creation by commercial bank is determined by two factors, that are the primary deposits, that is initial cash deposits, and the legal reserve ratio, that is minimum ratio of deposits which is legally compulsory for the commercial banks to keep as cash in liquid form. And broadly, when a bank receives such deposits from the public, it keeps a fraction of deposits as cash reserve and uses the remaining amount for giving loans. So in the process of lending money, banks are able to create credit through secondary deposits many times more than initial deposits, that is the primary deposits. So what the commercial banks are doing, that the initial deposits or the primary deposits that they are getting, they are creating money out of that, or they are creating credit out of that. That is a very important primary function of the commercial banks. So these are the three important primary or the basic function of the commercial bank. In our next class, we are going to study the secondary functions of the commercial bank, which are also very significant and important apart from these primary functions. Keep watching. Thank you.